Hey, today we're talking about auto-callable notes, a really neat investment product that's gained a ton of traction, especially in the last 10 years, and could be a fit for you and your portfolio. I'm going to tell you about what an auto-callable note is, who it might be for, and how they work generally. I'm Rob Tatro, head of the Tatro Wealth Advisory Group from robtatro.com, portfolio manager here at Canaccord Genuity. An auto-callable note really kind of started getting big in the last, I'll call it 10 years or so. Historically, it was quite simple. You had an underlying asset, so let's call it the TSX composite index. So maybe it was XIU, so it's an underlying index. And an issuer, usually a bank, would issue a note. An auto-callable note is a note, an investment note structured and issued by a bank where the underlying asset was measured and would be evaluated at specific intervals. So day one, XIU is at 100 points. Usually the valuation dates are annually. So next year on this date, if XIU is above 100 points, you get called. You get automatically called, hence the word auto-callable note. The note automatically gets called provided that specific outcome arrives. The specific outcome in the example I'm given is that the index is in any way positive. So positive by 0.1% or positive by 1,000% is irrelevant. They get called and you get the promised coupon provided it was called. So typically the notes will have a feature where if they don't get called at year one, the rollover will happen at year two. And then at year two, you will look again at the evaluation date and look to see if the underlying asset is positive. So for example, that I gave, if XIU is below par, is at 95 bucks on day 366, it doesn't get called. Year two, we take a look at the index. Where's the index now? Is it positive? If it's not positive, it doesn't get called. It gets rolled over. Year three, if it doesn't get called, all right, it rolls over. And eventually they have 5 or 6 year, potentially even longer durations. But if and when they do get called, that pays out usually a cumulative coupon. So the coupon might be, for example, 10% in year one, 20% in year two, 30% in year three. So if you don't get called in year one, you typically participate in that coupon at that end date. Now, that's how the notes started. And they were fairly simple concept initially. It was underlying asset, evaluation date, call feature, and the call feature was typically annually. Now, over time, they've become much more complex, and there's a whole bunch of different features that can be done. There can be a contingent income coupon where it gets called, but you also pay an income provided an underlying asset class is not minus 30 or minus 40%. You can get a principal protected callable feature where the entire principal is protected and you only get called if it's positive. You could also get some step down callable notes where in year one, as long as it's positive, but at year two, maybe as long as it's not -5 or worse, and you get called as well. So the callable features can vary, they can fluctuate, it could be a different number. The coupon certainly varies. You can get some that pay a whole bunch more upfront and smaller at the back end. These are very, very unique. They're very, very customizable. They're issued typically by all Canadian banks. Now, who do they belong to? Like, what are you replacing here? This is typically not to be considered a fixed income component, although it does pay a fixed income portion. And although the taxable consequences of the income is completely considered interest income, it should not be confused with your typical fixed income. These are typically replacing equity in most portfolios. So that is the allocation in your portfolio that is allocated to equity. Now the idea, the reason why some would consider it useful is you can streamline the income over time. So instead of getting the big swings of the equity market, so the 20% ups and the 20% downs, and you can in theory smooth that out. So some people like the predictability of it. Some people like the fact it's predictable. Some people like there's less volatility. They like that they can pick their underlying asset class, and that creates a unique need. And in fact, the neat thing about these is most of the issuers will custom create a note for a client, typically at the $1 million or $2 million level, meaning that you can get in and custom create your own note if you're very specific on your sector. Now, these can get created on any sectors like energy, American securities, Canadian bank stocks, preferred shares, gold miners. You can literally pick any sector and you can structure and create an auto-callable note. So auto-callable notes, they're not for everyone. Make sure to talk to your tax professional about the tax consequences of the income. Make sure to talk to your advisor about how you think it fits in your portfolio. But they do make sense for some people, and it definitely makes sense for the people who want to reduce volatility in their portfolio and create a consistent income stream with a predictable outcome. Again, I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisor Group. Thanks for joining us today.